the Bank of Jamaica earlier today announced its decision to increase the policy rate by a further 50 basis points to 7%, effective Monday the 21st of November 2022. We are not yet seeing the full pass-through to domestic food prices. In addition, core inflation, which excludes the impact of food and fuel prices, at October remained persistently high at 9%. The bank also notes that monetary tightening amongst Jamaica's main trading partners is continuing at a rapid pace. On the 2nd of November this year, the Fed raised its interest rate target by 75 basis points and signaled further rate increases to come. This policy stance could cause capital outflows from Jamaica and a faster pace of exchange rate depreciation if domestic monetary policy is not correctly aligned. It is in this context that the Bank of Jamaica earlier today announced its decision to increase the policy rate by a further 50 basis points to 7%, effective Monday the 21st of November 2022. The Monetary Policy Committee also decided to continue to contain Jamaican dollar liquidity expansion and to maintain a relatively stable foreign exchange market. This latest decision has resulted in a cumulative increase of 650 basis points in the policy rate since October of 2021. Also, since then, while maintaining a flexible exchange rate, the bank has taken decisive actions in the foreign exchange market, including selling foreign exchange when necessary. Without these actions, imported inflation and hence final prices faced by consumers would have been much higher. The bank's strong international reserves reinforces its ability to support the foreign exchange market as needed. The bank's policy actions were expected to cause interest rates on deposits and loans to rise further, making savings in Jamaican dollars more attractive relative to foreign currency assets and borrowing in Jamaican dollars more expensive. They are consequently expected to help to reduce the demand for foreign currency, underpinning a more stable exchange rate and hence lower inflation. The measures are also intended to constrain aggregate demand and consequently limit the ability of businesses to pass on price increases to consumers. Whilst there have been some increases in deposit and loan rates, the bank anticipates further increases in response to this policy signal. 12 months into the tightening cycle, and now at a policy rate of 7%, the bank judges that it is appropriate to pause any further policy rate increases and to watch its pass-through effect to deposit and loan rates. This pause is also conditional on seeing more pass-through of international commodity price reductions to domestic prices and on the Fed not exceeding their stated rate increase target for 2022. Let me now go into some details about the outlook for inflation and the economy. Over the remainder of this calendar year, November-December, assuming no additional shocks, the bank forecasts that inflation will continue to fluctuate between 9.5% and 10.5%. Consistent with consensus forecasts for a fall in commodity prices and the bank's overall monetary policy stance, inflation is projected to decline from these levels in early 2023 and to fall within the 4 to 6% target range by December of 2023. The forecast assumes that the public's expectation of future inflation will also continue to fall. The risks to inflation, the forecasts that I've just mentioned, are assessed to be balanced, which means that the actual inflation could be in line with the forecast. Factors that could cause high inflation include further supply chain disruptions and a spike in oil prices. On the downside, weaker than expected global growth could negatively impact domestic demand and imported inflation. Let me turn to the Jamaican economy for a few remarks. The Jamaican economy continues to perform creditably. The unemployment rate at July 2022 is 6.6%, which is lower by 1.9% to the corresponding number for the quarter of last year. In addition, there are signs that the economy has continued to expand for the September 2022 quarter, and the December 22 quarter to date. For fiscal 2023, the bank still projects real GDP growth in a range of 2.5% to 4.5%, following on growth of 8.2% for the financial year just ended March 22. The bank expects that GDP growth will continue to be driven by the services industry, particularly tourism, which has been recovering at a rapid pace. There has also been some buoyancy in the agricultural sector, which is expected to continue as the tourism sector recovers and weather conditions improve. Forecasted growth also reflects a recent resumption of production at the Jamaica alumina plant. GDP growth for financial year 23-24 is projected to moderate further as income growth amongst Jamaica's main trading partners normalizes to pre-COVID rates. The risks to the growth forecast are skewed to the downside. Growth in tourist arrivals and related activities could be adversely affected by headwinds to global growth. These headwinds include a deepening of geopolitical tensions and the continuation of synchronized tightening of financial conditions among Jamaica's major trading partners. Finally, there is a risk that domestic consumer spending could be adversely affected by the high domestic inflation. Let me turn to some other developments. The foreign exchange market has remained relatively stable, reflecting in part the actions taken by the bank in response to higher than targeted inflation. For the fiscal year to the 11th of November 2022, the exchange rate depreciated by 0.5%. Let me say that again. For the fiscal year to November 11, the exchange rate depreciated by 0.5%, significantly lower than the 6.7% depreciation recorded over the same period of the previous fiscal year. The central bank in this context sold $396.1 million via its B-Fixed facility over the period, complemented by sales of $442.7 million to selected public enterprises, including Petrodan. Notwithstanding these sales, the bank net purchased from the market over this period $521.6 million. At the 11th of November 2022, Jamaica's gross international reserves remained substantial at approximately $4.3 billion. The bank projects that the gross reserves will continue to remain adequate in the medium term. Growth in DTI loans and advances to the private sector has started to pick up in the September 22 quarter relative to the previous quarter. The quality of DTI's loan portfolio remains stable, with the ratio of non-performing loans to gross loans showing improvement when compared to a year earlier. Ladies and gentlemen, let me conclude. Monetary policy actions to halt inflation cannot be painless to all parties. However, the greatest pain of all is the impact of inflation on the ability of the working population to afford the basic necessities of food, transportation, and housing. In this regard, I wish to reaffirm Bank of Jamaica's commitment to doing all that it can to control